A few weeks ago, a 48-hour deadline put the entire world on notice. Iran was told to open the Strait of Hormuz or face obliteration. Global think tanks predicted disaster as 23 nations began moving military assets into the region. It looked like the start of a major war. But the deadline passed without a single missile being fired. The ultimatum received a 5-day extension, and Iran quietly moved to the negotiating table. While the media was screaming about an inevitable clash, the actual standoff just fizzled out. The world was watching the wrong battlefield. Iran never actually established a physical blockade, and the strait remained technically open for passage. This graph tracks the steady flow of energy tankers through the strait over the last several decades. Even without a naval barrier, traffic plummeted by 81% in a single week. If the water was clear of mines and torpedoes, we have to ask what invisible weapon actually sealed the strait shut. A financial choke point effectively paralyzed every tanker in the region. The blockade was written on paper, not enforced by hulls. According to this analysis, the real fight was playing out on balance sheets in the City of London. This network shows how British intelligence, central banking, and the Chatham House think tank coordinate with Wall Street to influence the flow of global capital. The center of this network is Lloyd's of London, the maritime insurance giant that has controlled high-stakes war risk coverage for over 300 years. Without Lloyd's insurance, a billion-dollar tanker cannot legally or financially leave the port. If they pull coverage, the ships stop moving, period. These balance sheets hold a more immediate grip on global logistics than any standing army. On March 2nd, for the first time in its 337-year history, Lloyd's completely canceled war risk coverage for the Strait of Hormuz. During the Iran-Iraq tanker war and the Gulf War, Lloyd simply decided to raise their prices. This total shutdown was a move without historical precedent. At the time, the UK was facing 2008-level borrowing costs and a severe domestic energy crisis. Their financial system was under immense pressure. By leveraging Lloyd's decision to make the Gulf uninsurable, London could disrupt energy markets to create leverage, pressuring the US and forcing Gulf states to rely on British financial systems for stability. This insurance blockade is just the latest maneuver in a quiet 80-year struggle over the pricing and flow of global energy. In 1945, President Roosevelt met secretly with the Saudi King on a U.S. warship to establish a direct relationship over oil. FDR deliberately excluded Winston Churchill from these talks, creating a deep rift between the Allies. London eventually regained its position as a middleman through the 1971 petrodollar system, placing itself back at the center of energy finance. Historical records show Gulf leaders found Churchill devious and preferred dealing with the U.S. directly to bypass what they saw as old imperial games. The U.S. strategy to counter this has been a multi-step process, starting with the long campaign to reach domestic energy independence. This map shows how the U.S. is now using that independence to build direct trade routes, bypassing the London-based financial nodes that historically set prices. The final goal is to insulate the U.S. economy from outside manipulation, ensuring that domestic costs are no longer dictated by foreign insurance policies. In the 21st century, a canceled insurance policy or a shifted commodity price can do more damage to a nation's stability than a fleet of aircraft carriers. National sovereignty is increasingly determined by the institutions that control the balance sheets, rather than the forces that physically patrol the water.